It didn't start with a crash. It never does. In fact, most market collapses begin in the exact opposite way, with confidence so strong it feels like nothing can go wrong. And right now, something unusual is happening again. People are searching one phrase more and more: Warren Buffett's stock market warning. Now here's the strange part. There is no flashing alarm bell, no dramatic press conference, no panic speech, just subtle signals, quiet moves, and a man who has survived every major market crash of the last 60 years doing something investors are paying very close attention to. Because when someone like Warren Buffett changes his behavior, the world doesn't ignore it. But before we talk about warnings, crashes, or predictions, I want you to imagine something. Imagine you are standing in a crowded casino. People are laughing, chips are flying, everyone believes they're winning. The energy is high, almost addictive. And then you notice something strange. The people who own the casino, the ones who built it, the ones who have seen thousands of winners and losers, they slowly start walking away from the tables, not running, not panicking, just quietly leaving. That's the feeling investors are having right now. And the question is simple. Do they know something, or are we just overthinking it? Stay with me, because what I'm about to show you isn't a prediction, it's a pattern. And once you see it, you can't unsee it. Let's rewind for a moment. Every major financial crash in history feels obvious after it happens. The 2008 crisis, people said the housing market could never fall. The dot-com bubble, they said internet companies were the future of everything, so valuations didn't matter. Even the COVID crash in 2020, it didn't feel real until it already happened. And in every single one of those moments, there were a few investors quietly stepping back, not guessing, not predicting, just observing. And one of those investors has always been Warren Buffett. Now here's what makes him different. He's not a trader. He doesn't chase hype. He doesn't react to headlines. He waits. And that patience has made him one of the richest and most respected investors in history. But patience also means something else. It means he notices when the market becomes irrational. Let's talk about what's actually fueling the current fear online. First, there's cash behavior. In recent periods, Buffett's company, Berkshire Hathaway, has been holding unusually large amounts of cash compared to normal cycles. Now, cash might sound boring, but in investing, cash is like oxygen. When everyone is fully invested, there is no oxygen left in the system. When someone starts building cash reserves, it doesn't automatically mean crash incoming, but it does mean something important. It means opportunities are not obvious right now, or worse. Prices feel too high for comfort, and that brings us to a key idea most beginners miss. Markets don't rise because everything is cheap. Markets rise because people believe prices will go higher, no matter the cost. That belief is powerful. It's also dangerous. Let me show you something. In the dot-com bubble, companies with no revenue were valued like tech giants. Why? Because people believed this time is different. In 2008, people believed housing prices always go up. In both cases, logic took a back seat. And when logic steps out of the room, emotion takes over. Now, here's where the psychology gets interesting. There are two emotions that drive almost every market cycle: greed and fear. But there is a third one that is even more powerful: FOMO, fear of missing out. FOMO is what makes people buy things they don't understand. It's what turns normal investors into risk takers. It's what makes a stock go from maybe I should buy this to I need this right now before it's too late. And once that emotion spreads across millions of people, valuations stop mattering as much until they suddenly matter a lot again. Now let's bring Buffett back into this picture. Because while the public gets excited, Buffett tends to do something very different. He becomes more selective, more cautious, and sometimes he simply waits. That waiting is what people interpret as a warning. But here's the truth most people miss. Buffett has been cautious many times before markets still went higher for years. So is he predicting a crash, or is he just refusing to overpay? That's the critical question. And there's no simple answer, but there is a pattern worth paying attention to. Whenever valuations across the market become stretched, meaning prices rise faster than earnings, long-term investors start becoming more defensive. Not because they know the exact timing of a crash, but because they know what happens after extreme optimism. Let's go deeper. Think of the stock market like a rubber band. The more it stretches upward without fundamentals catching up, the more tension builds. But here's the trick. That rubber band can stay stretched for a long time, longer than most people can stay patient. That's where most investors lose money, not by being wrong, but by being early. Now imagine you are Buffett. You've seen multiple cycles. You've seen people become rich on paper and lose it all in months. You've seen entire sectors become untouchable right before collapsing. Would you rush in just because everyone else is excited? Or would you wait for something better, something safer, something obvious? That's the mindset behind his strategy. And that brings us to another key signal people are talking about: market concentration. In recent years, a small group of mega companies have driven a large portion of market gains. That sounds impressive, but it also creates risk, because when too much of the market depends on too few companies, the system becomes fragile. If those leaders stumble, the entire index feels it. We've seen this before. In the dot-com era, a handful of tech stocks carried the entire market narrative. When they fell, everything fell with them. Now, I want you to pause for a second and think. Not about predictions, but about behavior. When excitement is everywhere, when news is overly positive, when everyone around you is talking about how easy investing is, that is usually when discipline matters most. Not panic, discipline. And discipline is exactly what legendary investors rely on. But let's make this even more real. Imagine two investors. Investor A is emotional. He buys when everything is rising. He feels smart when prices go up. He panics when prices fall. Investor B is boring. He waits. He studies. He buys when things feel uncomfortable. He sells when things feel too comfortable. Over time, Investor B doesn't look exciting, but he survives every cycle. That is the difference between speculation and investing. Now let's come back to Buffett again. One of the most important things to understand is that Buffett doesn't need to predict crashes to outperform. He only needs to avoid big mistakes and wait for opportunities that others are too emotional to see. That's it. No magic, no secret formula, just discipline over decades. But here's where the tension comes in, because when someone like Buffett becomes cautious, the internet doesn't interpret it as discipline. It interprets it as a signal, a warning, maybe even a prediction. And that's where narratives explode. Now let's address the big question everyone is silently asking. Is a crash coming? The honest answer is uncomfortable. Nobody knows. Not analysts, not influencers, not even the most successful investors in the world. Markets don't announce their turning points in advance. They reveal them in hindsight. But what we can do is something more useful. We can look at conditions, we can look at behavior, we can look at history, and we can understand where risk tends to build. Right now, some investors see high valuations, others see strong innovation, some see danger, others see opportunity. Both can be true at the same time, because markets are not a single story. They are a collection of millions of conflicting beliefs. Now let's slow this down and make it personal, because this isn't just about Buffett. It's about you. Every investor, whether they have $100 or $100,000, eventually faces the same emotional trap. The moment when everything feels like it will keep going up forever. That is the moment where risk quietly builds. And the hardest part, you don't feel it while it's happening. You only recognize it when it's already gone. That's why history matters, not because it repeats exactly, but because human behavior does. Fear, greed, FOMO, regret, these emotions never change. Only the assets change. Now imagine the next market cycle. Prices fall, news turns negative, people panic, and suddenly the same assets that felt too expensive become obvious opportunities. That is the cycle. And that is what long-term investors prepare for, not by guessing timing, but by staying emotionally balanced. So what should you take from all this? Not fear, not excitement, awareness. Because whether Buffett is warning the market or simply acting cautiously, the real lesson is the same. Great investors don't react to hype. They react to value. And sometimes the most powerful move in investing is doing nothing at all. because doing nothing protects you from the mistakes that destroy most portfolios. Now, I want to leave you with this thought. If everyone is rushing in one direction, and the people who have seen every cycle are quietly stepping back, it doesn't automatically mean disaster is coming. But it does mean you should think more carefully than the crowd, because in markets, the biggest losses don't come from ignorance. They come from confidence at the wrong time. And the hardest truth is this: you will never feel fully ready for the next crash before it happens. But if you understand the cycle, if you understand the emotions, if you understand the behavior behind the noise, then you won't be reacting like everyone else when it does. You'll already know what it is. Not a disaster, not a mystery, just another turn in a cycle that has repeated again and again, long before any of us were here and long after we're gone. And maybe that's the real warning people are hearing from Buffett. Not that something will definitely crash, but that the market always looks safest right before it stops being safe. And the question you have to ask yourself is simple. Are you investing based on what feels good right now, or based on what has actually survived every cycle in history?